Hi, everyone. Thank you for joining us tonight on this week's episode of Endowus Live. My name is Greg. I'm a founding partner of Endowus. And today we're talking about how to 10x your CPF, SRS, and cash, so all of your money, towards your life goals. And I think, what inspired me to do this session was we've been doing a lot of corporate webinars. So webinars to a lot of employees of a lot of partner firms, from large tech companies to large financial services companies, to consumer-focused companies. And I really wanted to consolidate the Endowus investment philosophy in an hour. So that's what we'll attempt to get through in the next hour. Talk about this concept of 10x, an evidence-based approach to investing, what Endowus does, why you need to invest your CPF, how to actually use your money and know that you have enough. So I hope we can get through that today. Really quickly, if you're not subscribed to the Endowus YouTube channel, please subscribe to us below. Next week, we have a really exciting session with 3 big players in money management in Singapore, from UOB Asset Management, Fullerton Fund Management, and Lion Global, breaking down cash management, in particular, the Endowus Cash Smart Solutions and the engines behind those solutions. There's a link to sign up to that. Event below in the description of today's webinar. Last logistics before we get into the content. If you have any questions, please check out Slido. Just type in your browser, sli.do, with this code 80407. From there, you'll be able to upvote questions. There are already some questions that have come in for the night. So open another tab, check that out. If you have any questions, please ask them there. And with the ability to upvote, we'll be able to address them at the end of this session. Really quickly on Endowus, we help people invest better for the purpose of helping them live easier today to be better prepared for tomorrow and retirement. Our purpose is not to give you trading ideas. It's to give you a solution that is holistic across all of your money. Education is absolutely critical and at the core of what we do. We've given talks at SGX, we've given talks in technology summits, and we give a lot of talks on YouTube to help educate people so they know how to run their money more efficiently so that it works better for their life. Really quickly on the team, we started Endowus because we were struggling from this pain point ourselves. High costs in investing, poor and misaligned advice, a lack of access to good products. A lot of us came from the finance industry. Sam was the former CEO and Chief Investment Officer of Morgan Stanley Investment Management in Asia. Sin Ting was in private banking for 8 years. I started my career in investment banking at UBS, followed by working on the Grab team and starting the payment business there. Yuning ran a family office of over $1 billion here in Singapore. JX on my right, he graduated from Wharton. He worked at ByteDance, the company behind TikTok, Lyft, and Dropbox in the US, and is an EDB scholar. Ju has been building trading platforms for a decade. We started Endowus to solve the investment problem of our families, for ourselves and our families, because we know the right way to invest. And the problem we saw was 3 parts: a lack of access to good products. So we wanted to solve that with better access to products, high cost, high sales charges and transaction fees. So we solved that by being lower cost, very much helped by technology to bring the cost down further, no sales fees, and 100% trailer fee rebates. And finally, being able to provide aligned and suitable advice. As a result, what you get with Endowus is your ability to control everything from the Endowus platform. We're a licensed financial advisor. We can help you if you need help. A lot of the advice is self-service on the platform. You there can get your advice towards multiple goals in your life: portfolio construction, monitoring, access to products. We partner with the largest domestic broker, UOB Kay Hian, to act as your custodian. So when you create an Endowus account, we create a UOB Kay Hian account in your own name, and you send money there, whether it be CPF, SRS, or cash, and we execute your portfolio for you. And what you get with Endowus is the ability to invest very efficiently in the world alongside some of the best fund managers out there. We like to think of your money in buckets. Okay, so you take the appropriate amount of what we call compensated risk based on your needs. And on the Endowus platform, you can have multiple buckets. Cash management to earn anywhere from 1 to 1.7, 1.8% with very, very low risk. It's a great replacement to fixed deposits. This is perfect money for a rainy day or things you need in the next 12 months. If you have a bit more time, you have the ability to take on more risk. So you can maybe buy a 20% stocks, 80% bond portfolio and create a bucket for things you need in the next 2 to 5 years. And then for 5 to 10 years and 10 plus years, you can afford to take on greater volatility, so greater ups and downs, in order to capture higher expected returns. That is what Endowus does for you. We manage that for you all on the go. You can use this on the mobile app, now available on the App Store, Google Play Store. Download the app and check it out, or just do it online at endowus.com, where you can manage everything from your web dashboard. Today's topic, 10x your money, is a 3-part series. And if you've joined our corporate webinars before, this will be a lot of refresher information for you. But I think this is absolutely critical in your wealth journey so that you can invest better to live better. Number 1, the most important things about evidence-based investing. This is foundational information. Number 2, how do you build wealth with your CPF, SRS, and cash? Why would you invest your CPF when CPF OA is paying 2.5%? Number 3, how do you know how much you need? And how do you know the probability of your money lasting? Very, very important. And for anyone who is a client of Endowus, you know how much we care about this. You need an investment strategy that you can commit to holistically across all your money and have a certainty of outcomes. So this is very important. A lot of people we find invest not holistically. So they'll invest maybe 1% of their money in some stocks that they believe in. In total, their entire stock portfolio might be 10% of their money. And then they'll be sitting in a lot of cash. This will never help you be wealthy because you need to expect such outsized returns of that money that you are investing. So you need a strategy that is holistic with a higher certainty of outcomes. So that strategy has to be rational. And you need to be able to behave unwaveringly when volatility strikes, as it did earlier this year. We talk a lot about 10x your money. And you may think, well, 10x is just to get me to watch this webinar. 10x is actually very realistic in our lifetimes. But in order to achieve 10x, you need to be holistic. Okay, so if I earn 7.5% per year, which is lower than the average returns of stock markets, I would 10x my money in 32 years. If I had invested in something that earned me 2.5% for the same period, I would have a 110% return after 30 years. Okay, fast forward, if you're 30 years old today, if you're 40 years old today, it is likely that you have another 60 years to live. After 60 years, you can expect to 76x your money. That is the power of compounding. If you invested in something and left it in something that earned 2.5%, your end result would be up 340%. So, this isn't just a formula, right? I'm giving you these numbers, and this is just pure math. I'm not talking about the markets at all. This is just pure math. I'll be talking about how to achieve these returns with a higher certainty of outcomes, how to achieve a higher expected return by being holistic. And the problem, very, very important, of not being holistic is cash drag. So your cash will earn zero or next to nothing, zero or very, very close to zero. Cash sitting in your bank today is earning 0.05% at most of the major Singapore banks. Therefore, the money that you are investing needs to return unrealistically high returns for you to 10x your total wealth. So in this example, we have cash holdings on the left, cash holding percentage on the left, investment holdings in the middle, and the annualized return required to double your money every 10 years on the portion that you're investing. So if you invest 100% of your money, you need a 7.2% return to double your wealth. If you invest 60% of your money, you need a 12.8% return to double your wealth. If you invest 20% of your money, which is where we find many of our customers when they come to us, you need a 26% annualized return to double your wealth. And just how absurd is 26%? Warren Buffett is one of the best, if not the best investors of our generations. He has a 54-year annualized return of 20.3%. He is an outlier of an outlier of an outlier. Generating these types of returns can make you one of the wealthiest people in the world. Unfortunately, it's unrealistic to think you can generate these types of returns. So I have a lot of friends who have bought Tesla this year, for example, and have made multiple times their money on Tesla. But is buying Tesla something you can do with all of your money? The answer is, I would not be willing to take that risk with the money of myself and my family. I need something holistic I can rely on for the long term, something evidence-based. And that's what we want to talk about. In the end of the day, there is no magic. There is only compensated risk and return, right? As I become more concentrated in my investment approach, I can expect to have a greater dispersion of outcomes. But if I am very diversified and take compensated, intelligent risk, in the case of Endowus, you can be diversified across 13,000 companies from your phone. If I can be diversified and capture compensated risk, I can be rewarded for that risk by staying the course. Focus on what you can control as an investor: your career, your asset allocation, diversification, your investment costs, and of course, your behavior. You need to know why you're invested the way you're invested. You cannot control the economy. You cannot control COVID. You cannot control when the travel bubble is opening again. You cannot control when the vaccines will be distributed to everyone. You cannot control short-term stock market movements. So the key here is to be invested in a way that suits your life, in a way that is geared. You can have multiple buckets in a way that is geared towards your life goals. And that's the topic of tonight: 10x your wealth towards your life goals. And it's very important to remember the beginning. Okay, so let's rewind to early 1900s. JP Morgan and I love this quote, I use it all the time. JP Morgan is the foremost banker in the largest, richest country in the world. And when he is asked what the stock market will do, his response is simply that it will fluctuate. He doesn't know if it's going to go up or down, because if it goes up or down in the short term, it's very, very random. Just look at this year, for example. Okay, so in green is the All Country World Index. In blue is the Bloomberg Barclays Global Aggregate. We started off the year, things were humming along. COVID, you guys remember, mid-February struck the stock market. The stock market went down by over 30% in the following month and has had this roaring return, roaring comeback. Yes, there has been periods of volatility of drops of over 5% where people got nervous. But as of right now, we're up 13% for the year. Global bonds, which also had a major shock, are up 5.5% for the year. This is in US dollars. When we zoom out, you need to remember that if you position yourself properly in the markets, they can work for you. And there has to be a rational understanding. There has to be a rational reason for why this phenomenon exists. So we look for evidence and we look for reason. In the case here, the US has the richest, most high quality market data. We rewind to 1926 to the end of 2019. Of course, this chart would look higher if we did it up to today, but we do it on the annual, we update it on an annual basis. So to the end of 2019. If you had put $1 under your mattress, the safest thing you can do with $1, so-called safest thing you can do with $1, it would still be $1 today. If you had matched US inflation of 2.9%, $1 would be $14 today. And mind you, 2.9% is higher than the current CPF OA rate of 2.5%. If you then took on a little bit more risk, so you lent money to the US government in short term, you would earn 3.3% annualized return, or 22 times your money. Look at this power of compounding. As we go up by just a little bit, we just basis point by basis point. If we go up by just 0.5%, look at what it does to your outcome over a period of length like this. If we go up a little bit further from 3.32% to 5.65%. So now US longer-term government bonds. Short-term government bonds will have less volatility and therefore lower expected return than long-term government bonds. $1 becomes $175, so 175 times your initial investment. If we go up by just under 5% to 10.2%, US large cap companies. In the case of this, we're using the S&P 500 as an example. $1 becomes $9,237. Now, why? Why is it that stocks return more than bonds? If you think about it, you need to be rational about it. If you think about it, if a company went bankrupt, the bondholders would get paid back first. And then whatever was remaining would be split among the equity holders. So if for a prolonged period of time, stockholders were not compensated in the form of returns for holding on to that stock, people would just own the bond instead. Stockholders in the long run have to be compensated for taking on the additional risk of owning the stock versus owning the bond of a company. Okay, so why then do small caps have a higher expected return than large caps? So from 10.2% to 11.4%, $1 becomes $25,600. Okay, so that 1.2% increment in compounding returns has resulted in an over 15,000x return. The reason is very simple. What type of companies are more risky? Large cap companies or small cap companies? The answer is small cap companies. Mind you, during the Great Depression, small cap companies went down by over 80%. Right here, by over 80% in the 30s. So by taking incremental compensated risk, I can achieve a higher expected return. The markets fluctuate because every day, hundreds of billions of dollars are being transacted in markets trying to find these prices. When you invest in markets, you are getting the collective wisdom of the crowd and the way they see the future. You can position yourself in markets to succeed by taking the appropriate amount of compensated risk, but you have to be diversified. Recent world history paints a very similar picture. You might be able to say, well, okay, that sounds great, but I like Tesla. I like Tesla because it's gone up a lot recently. I believe in Elon Musk. I like Amazon because Jeff Bezos has built the biggest, he's the richest man in the world. He's built the most impressive e-commerce company. No one will take them down. The fact of the matter is, all of that is already baked into the price. And that price is fluctuating every single day, trying to find out what the price should be. So if I asked you if you should buy today Tesla or DBS, the answer is the risk return of owning them at their current prices is already baked into the price. And you can maybe be right once or twice, but it's very hard to be consistently right and achieve a higher expected return than the market. So recent world history paints a similar picture. Global small caps have a higher expected return. Global small value companies have a higher expected return, but more volatility than global small caps, than global large caps, than global bonds. The Endowus portfolios express this very well. So very quickly, if you go to the Endowus website by scanning this QR code, publicly we show the returns of all of our portfolios across this risk spectrum in ratios of stocks and bonds, investable with your cash, CPF, and SRS. And you can transparently see what these portfolios have done year to date, what they have done historically year on year. One thing I really quickly want to point out is this is a 60% stocks, 40% bond portfolio with a 7.3% annualized return, returning 6.9% so far this year, 6.6% in the last 1 month. In 2008, it went down by 28%. We have no shame in saying so. In 2018, it went down by 5.5%. You are buying volatility. You are buying the fluctuation to get a higher expected return. If I go to 100% stocks, year to date, this is in Singapore dollars, year to date up 8.3%, in the last 1 month up 9.6%, annualized return of 7.9%. So higher than the 60-40 portfolio. If you scroll backwards in 2008, it went down by 40%. It's very hard to time when these fluctuations will happen. This is COVID right here. But you need to believe as an investor that the longer term rules will persist. Okay. So what we have learned from studying markets is that prices reflect information and are difficult to outguess. Different types of securities have different expected returns. I just went through that. Capturing higher expected returns requires diversification, cost management, and patience. Again, every day, all this information, perception, it could be from a dream or from research you did for the last 3 months, is being injected in the markets. Everyone is trying to find prices. The price today is therefore the collective human perception of the world and all the companies within it. You need to position yourself properly based on your goals to achieve these returns that markets deliver. And when people try to outguess the market, it's very difficult. Professionals also struggle with this. In 2017, and if you've ever bought a fund before, you would no doubt have seen the Morningstar ratings. In 2017, the Wall Street Journal did an expose on the Morningstar ratings and showed that if you are 5-star rated today, you only have a 14% chance of still performing at a 5-star level in just 3 years' time. The persistence of returns, therefore, in public markets is low. Trying to pick the best manager, trying to pick the best sector is extremely difficult. And for the individual, the situation is even worse. JP Morgan publishes something called the Guide to the Markets and shows us the 20-year annualized return by asset class and of the average investor. The average investor consistently does around inflation. In this case, our average investor did worse than inflation. Why is that the case when the markets have generated significantly higher returns over the same 20-year period? It is likely because of behavior. Investors severely underperform over time because of panic selling during downturns and overbuying during market highs. This has happened over and over again. It does not matter if you are trading on IBKR or if you're trading on another brokerage firm, a higher cost brokerage firm. This behavioral aspect in investing, the desire to chase returns and be fearful when others are fearful is ingrained in us. And the average investor has struggled because of it. And we think it's very unfair. We talked a lot about 10X, and I wrote a paper on this earlier in the year. When we were going through the COVID crash, we were talking to a lot of clients about their asset allocation. So the way they were invested in stocks and bonds, global stocks and bonds, and how that was very efficient at Endowus. But in order to achieve higher expected returns, you need to be able to sit through years of waiting. We created this chart which shows us the returns over different time periods. So on the left here is the starting year of investment, and on the top here is the ending year of investment. And what you can see is many different colors. And don't try to look at the numbers. The numbers are very small. Just look at the big picture colors. You go from white and red on this first line. Let me see if I can pull up my pointer. On this first line, you go with white and red, in some cases, very deep red. This deep red is negative 40%, representing the global financial crisis. As you progress in this journey, it becomes lighter in green to darker in green to green with white numbers. And this is the key to read this chart. If it's dark red, it means that your total return was between negative 50 and negative 30%. If it gets into a lighter red, it becomes negative 30, negative 10. In white, it's a positive 0 to positive 30%. In a light blue, in a light green, 30 to 200%, so on and so forth, until we reach the white numbers. And that is when you have 10x'd your money. And that includes investors, who lived through the COVID crash over here in this last column. Of course, their investment period is very long. So when we talk about 10x'ing your money, it's actually very realistic. For anyone who started investing in these periods and held on, they would have 10x'd their money. We use the MSCI World in the case of this example, which represents the global developed markets, which has data back to 1970, which is when this research started. And, it's difficult because every single day we get so much news about what we should be doing with our money, how we should be invested, the companies that are winning and losing, etc. If you watch the movie 1917, it kind of reminded me of the investor's journey. He starts under a tree before investing at all, rather naive and unknowing of what the challenges lie ahead. He moves towards the front line in the movie, and as he approaches the front line, it becomes bloodier and muddier. Then he's asked to go on a mission and cross that front line through the barbed wire and try and deliver a message to save a lot of his fellow soldiers. So that is the general storyline of the movie 1917, and that is kind of the journey of the investor. Rather naive, we know that we should be investing. We don't know necessarily how to invest. We don't really know what to expect. We don't know when to enter. We get a lot of questions on, is now the right time to be invested? Academically speaking, if you should be invested in 100% stocks because that is most appropriate for your goal, because your goal is 20 years away, then you should just be 100% invested in stocks today, irrelevant of the price, because more often than not, the stock market will go up, which means that if you try to dollar cost average, you'll be dollar cost averaging in at a higher and higher price. But we still get that question all the time, because if you invest in 100% stocks, it can go down by negative 40, negative 50% once every 15, 20 years. You, as a person, need to be ready to go through that agony. And it is agony. And we, as an advisor, we have no idea when these negative shocks will happen. If I knew, I would tell everybody and they would be much better off, but it is just not possible to time that market. So you go through the barbed wire of returns, you clear it, you're in the green, you feel very good about yourself, you can reach the 10x returns. We don't need to be exceptional investors to reach that 10x outcome. So frame it in your mind. You want to be holistic with your wealth. You want to be fully invested towards your goals, and you can reach that 10x outcome with all your money. Famous Warren Buffett quote, "We continue to make more money when storing than when active." An evidence-based strategy really rewards long-term investors who can sit through years and years of waiting. We talked about the markets working for you if you position yourself properly within them. Now let's talk about trying to time the markets. We originally published this article back in 2018. Business Times picked it up. For any of you who have heard my webinars before, I constantly refer to this, and it's of the worst investor in the world. So the definition of the worst investor in the world is he only invests, or he or she only invests, before the markets go down by 20% or more. The reason why this is such a powerful concept is because so many people ask us, is now the right time to invest? The markets have gone up too much. I agree that the markets are high. They are at an all-time high, in fact. But will they go up another 40% before they come down by 20%? And the answer is, I don't know. But looking back at history, we should always be invested towards our goals because we cannot control the markets. This investor starts his journey in 1973, and right after he invests, the market goes down by 41%. He finally gains the courage to invest again in 1987, just before Black Monday. The markets dive by 20% for no real good reason. Through this process, from getting from this worst investor to this worst investor again, there was plenty of news around sort of the death of markets. Gold is the only place to be safe. In that period, gold hit records. US inflation hit record highs as well. Business Week called for the death of equities. Okay, let's continue on this journey. We have the Asian financial crisis, the Russian financial crisis. This is in the late 90s. In 1999, the markets run up because of the dot-com boom. In that time, this investor, being the worst investor in the world, invests at the peak. The markets tank by 46%. He goes through the dot-com crash, followed by 9/11, the beginning of the Iraq War, and then one of the greatest bull runs, short and fast bull runs, from that bottom to the start of the subprime mortgage crisis. This is now 2007. He invests another $100,000. It goes down, the markets go down by 54%. If he were to look into his bank account at the bottom of the bottom in February of 2009, he would have earned a 6.3% annualized return, or have $1.5 million in his bank account. Now, if he did not have to take his money out at that period of time, he would have rode one of the greatest bull runs through the trade war, Brexit, US fiscal cliff, you remember Eurozone debt crisis, all these things, and then finally invested another $100,000 just before the COVID-19 crash. When we republished this article, he would have been up 1,332%. The worst investor in the world would have 10x'd his wealth in this period. Okay, so this 10x theme keeps on coming up. Then you have the guys who say, okay, I know I need to be invested, but I will pick the markets because I read the news, I'm well informed, I have a degree in economics or whatever it is, I can pick which markets to buy now. Now, let's rewind back to 1970. In 1970, Japan was hot. Okay. Let's say you were the best investor in the world and you just bought Japan. In the 70s, you would have had a return of 396%. The US in the same period would have had a return of 76%. So almost 5 times the return of the US in that period. Then you might have said, well, okay, maybe Japan's overheated, I should trade into the US instead. In the 80s, you would have had a 400% return if you invested in the US, and you would have missed out on another decade of incredible returns from Japan. 1,147% return in the 80s. Now, we talk about these decades like, oh, it's the 70s, the 80s, like no big deal. You have to remember, that is 3,650 days of watching the news and trying to figure out what to do with your investments. Year by year, these guys, they traded places all the time, right? If you invested in the 80s, you would have said, whoa, I was right. Look, the US was up 32%, it beat Japan. In 81, the Japan was up 15%, the US was down 5%. How do you guess which markets will outperform and when? It's very difficult. If you're an investor who lived through the 2000s, the 2000s, you would have seen the rise of the emerging markets. You would have seen the rise of the BRIC countries, Brazil, Russia, India, China. Every bank was selling the BRIC funds because emerging markets had the best return in the 2000s. If you had moved into the BRIC funds in 2010, you would have had the worst return from 2010 to 2019. Emerging markets underperformed Japan, the US, and the rest of the developed markets from 2010 to 2019. It's incredibly hard to pick which markets will outperform when. It's incredibly hard to know where the sources of returns will come from. And if you are constantly chasing the next thing or trying to guess which markets to go into, you undoubtedly, with a very, very high likelihood, will underperform your longer term strategy. Returns are random. This graph shows us, or this diagram shows us, returns of different asset classes over time and how they change from highest to lowest very, 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 very frequently. And there's no real pattern to be seen here. It's not like if you're the lowest one year, you'll be the highest the next. That pattern does not exist. When we look at developed markets, it's a very similar picture. Singapore was up 99% in 1999. In 2000, it was down 30%, followed by down 23%, followed by down 11%, followed by up 37%. And you can see how this list there's no real relationship. The returns are really random. We don't know where the sources of returns will be. Finally, emerging markets, very similar picture. These are very pretty graphs. Please try and imprint them in your mind and stay humble as you approach investing. When we're in the thick of things, again, I talked about the decades being like, 3,650 days of being inundated with information, trying to decide what to do, trying to decide whether or not to buy or sell Tesla today. The largest companies in the world change a lot. If we rewind back and we printed basically the biggest companies by market cap at the end of every decade. 89, a lot of these names are in Japan. Only 2 companies here managed to cross into the next decade, to be on this list a decade later. A decade later, some tech companies, still a lot of oil companies, Walmart is here as well. Okay, fast forward another decade. All of the white names are new. All of the white names on this list did not show up more than once. Apple creeps onto the list here in 2009. We have Exxon only on the list because it merged with Mobil. Microsoft managed to cross into the next decade. Walmart past 2 decades. Finally, 2019. So this is the end. This is in December of 2019, about a year ago. This was the list of the biggest companies in the world. A lot more tech, a lot more US companies right now, the creeping in of Chinese companies as well. I don't know what this list will look like in 2029. It's only been 1 year, and this list feels as though, and the companies in command really feels as though it's already transformed. So what will this list look like in 2029, 2039, 2049, when a lot of us, I'm sure, will be looking to retire? What will this list look like? And you have to be humble because you really don't know. Finally, very important, cost is very important to your returns because it goes straight to your bottom line. If you manage to save 1% in fees, assuming a general market return, you're looking at a 245% return, 245% return difference after 30 years. That's just by saving 1% in fees. And a lot of people say, well, I don't mind paying for returns if that fund can deliver outperformance. That relationship does not exist. Morningstar, who we criticize for the ratings, has come out and said many times that the expense ratio is the most proven predictor of future fund returns. And they proved this by separating funds out from the cheapest to most expensive in terms of their quintiles and seeing their propensity to beat their benchmarks. And as you can see, the cheaper the fund, the higher its likelihood of beating its benchmark. Here, for sector-based equities, international equities, balanced funds, bond funds, and government bond funds. So across the entire spectrum of investable assets, this relationship exists. So the most important things about evidence-based investing are diversification, cost management, and patience. Now, why would I invest my CPF? My CPF pays me 2.5% guaranteed by the government. But as we just learned, your CPF is your long-term money. It is your money not to be used now. I mean, yes, you can use it for certain things now, but it's to be used for the long term, not when you hit withdrawal age. It's used to pay for your lifestyle after retirement, from when you retire until when you pass on. So it is with this type of money that you should be accepting volatility to capture higher expected returns. The OA rate fluctuates as well. So this is going back to 1990, looking at OA rate in black and the Singapore savings deposit rate in red. The OA rate is relative. For the last 20 years, it has been stuck at 2.5% as legislated by the government. Okay, now look at this graph from 0 to 5%. I now change the scale from -40 to 40%, and what I've done is layered on top of it global equities. Now, looking at global equities in yellow, we can see -20%, positive 10%, positive 20%. It's very violent. It's a very, very bumpy ride. Global financial crisis, over -40%. But what would happen if I invested my CPF in that time period versus leaving it in the CPF system? It's earning 2.5%, or the prevailing rate through the time period. What I would see is that I would have a 406% total return as of June 2020 versus 135% total return if I had left it in my CPF. And this applies not just to CPF, but also your cash savings. You know, what would happen if I left it in the bank versus investing it? Or your SRS, what would happen if I left it in the bank versus investing it? So, but CPF is a more extreme example because it pays the 2.5%. So I saw some questions on Slido around, you know, what is the likelihood of Endowus beating the 2.5%? And it's really about understanding the amount of time you're going to be invested. We don't just look at the general, but we look at the best and worst outcomes as well. So in the best outcome of a 20-year period, which is not a long time to be CPF invested, You're looking at a 280% return versus a 72% return of not being invested. You still went through the dot-com crash, you still went through the global financial crisis, but you get a 280% return. If I invested in the MSCI All Country World Index in the worst 20-year period versus CPF, for a lot of it, you would have been underwater. And for that period where you're underwater, you've been kicking yourself and wondering, why did I listen to these people? Why did I invest my CPF? At the end of it, you had to sell everything in this worst 20-year period at the beginning of in the flash crash at the end of 2018, when the stock market went down by 20%. There were some trade war fears at that time, but the stock market went down by 20%. December 2018. You would have been up 94% versus CPF up 65% in the same period. So when you think about the probability of beating that 2.5%, we think about it in terms of the time that you are invested. 1 year, 3 year, 5 year. In a 1 year period, you're looking at a 60% chance, a 65% chance or so of doing better than the 2.5%. When we get to a 10-year period, we're looking at a near 80% chance of beating that 2.5%. If we go down in risk and invest in, for example, a 60% stocks, 40% bond portfolio, we're looking at an 85% chance. Think about it this way. It's all relative. A fundamental question you need to ask yourself before investing at all is, do you think the world, with its population growth and technological innovation, will produce more goods and services 20 years from now? And if the answer is yes, then you absolutely need to participate as an owner in that future. And that is what we are able to do today, not only with our cash savings, but also our CPF with the help of firms like Endowus. So what you get with Endowus is your portfolios. These are 3 of our portfolios from 100% stocks, 80% stocks, 60% stocks versus the CPF OA rate. And as you can see, as you increase in risk and higher expected return, you also become much more violent in the ups and downs. Higher returns are not free. You need to pay for them by taking on volatility, by taking on bigger shocks. Again, we are very, very focused on helping people reach their goals, and they need to be realistic about those goals. They need to be realistic that investing in a 60% stock, 40% bond portfolio, yes, may have an average annualized return of over 6%. But in the worst 12-month period, it went down by almost 30%. Can you tolerate seeing your money go down by almost 30%? In a 5-year period, the worst 5-year period went down by 8.7%. But in the worst 10-year period, it was up by 44%. So in the end of the day, building wealth through your CPF, SRS, and cash is about how long you're going to be invested, how much volatility you can tolerate, and this sense of relativity. We all live in a relative world facing the same market. The CPF OA rate is actually very relative to the bank rate and what stocks will be performing at. So keep on thinking about these broader concepts, and they will help you stick to an investment plan for your life cycle and reach your 10x. With Endowus as a financial advisor, licensed by MAS, as CPF, as the first and only digital advisor for CPF, SRS, and cash, what we do is work with fund managers who manage hundreds of billions, if not trillions of dollars, and make their products available to you for your money so that your money can be running efficiently. An example of this is how Endowus today is the only way to access passive funds, including the S&P 500 and the Global Stock Index Fund, which tracks the MSCI World, with your CPF. These are lower cost options. They're more diversified, more evidence-based ways of gaining exposure to these markets. We work with great partners for other parts of the asset allocation to not ignore, of course, emerging markets and Asia exposure. Schroders and First State in our equities portion. And then in fixed income, we work with global partners to create portfolios suitable for your risk tolerance and your goals. Finally, using your money and making it last. And I'll use this chicken as an example. Think about your money in buckets. And I talked about this at the beginning of the presentation, but this is very, very crucial to understanding how to use Endowus properly. On the Endowus platform, you can have multiple portfolios working towards different goals with multiple sources of funds. So I can have my CPF, SRS, and cash all invested in 80% stocks, 20% bonds, for example, working towards my retirement. I can have my cash invested in Cash Smart, earning an expected yield of 1.7% for a rainy day. I want to renovate my house in 5 years' time. I want to grow my wealth at maybe a 3 to 5% return in that period. I can invest in 20% stocks, 80% bonds, and try and reach that goal. So we're matching risk with the time that you need to reach that goal. And that's really how you should think about using the Endowus platform. Big question though, how much money do I need for my retirement, and do I have enough? And yes, this is possible to be calculated. We call it a three-step process, three steps to evidence-based retirement investing. The first step is to select a rate of decumulation. So in the case of our chickens and eggs, it's the rate at which you eat your eggs. Of course, you need to take into account inflation so you don't decrease your quality of life from age 65 to 95. And 95 is a very realistic number for many of us. 65 to 95 is still a 30-year period. That inflation will eat into your quality of life if you do not take care of your wealth. Number two, decide on how much volatility you can tolerate, and this is a behavioral choice. And then number three is understanding the risk of running out of money and how aggressive you should be in terms of your contributions to your goal to understand the risk of running out of money. Life gets more expensive. In the last 50 years, the price of goods in Singapore has risen by about 5 times. From age 50 to age 100, you should expect the same thing. The price of goods will rise by 4 to 5 times. You cannot keep money under your mattress and expect to maintain the same quality of life. And it's about the chickens and the eggs. So in life, you have 2 chickens. In life, we like to bucket wealth into 2 chickens, or yourself into 2 chickens. Number 1 is your work chicken. So this is you, your work, your creativity, your labor, and that is translated into a salary or something you earn, right? If you're a freelancer, that's the amount of money people pay you for jobs. We call this human capital. The number of eggs this human capital produces, so the amount of money that eggs are things that you can store, will typically grow through your working life as your salary increases, but it will slow down as you reach retirement typically. Okay, then you have your wealth chicken. And this is the money that you accumulate or inherit or invest. And we call this financial capital. The number of eggs the wealth chicken produces is dependent on the amount of capital accumulated, so the size of that chicken, and the type of food you feed it, which is the way you invest it. Now, very important is that both of these chickens, they produce different they produce different amounts of eggs. They produce different amounts of eggs throughout your life. Many people call this wealth income, passive income. And that's really what we're focused on here. So at some point in your life, if you did this perfectly in your 50s, your wealth income would surpass your work income. Okay, so this red line represents additional wealth from that wealth income working passively. These blue lines represent your salary, what you make in any given year. And you have a choice. You can kill the chicken and store the eggs. You can feed the chicken a little bit in the hope of, with a little bit, but take very little risk. So earn that 2.5% in the OA. You can take on a little bit more risk and invest your money in, let's say, a 60% stocks, 40% bond portfolio, or you can let the chicken run free in the hope of many golden eggs. Invest your money in a globally diversified portfolio of 100% stocks. And we talked about that three-step process: the withdrawal rate, your behavioral tolerance, and the risk of running out of money. Okay. This is a 5% withdrawal rate, and we use the example of $1 million. It could be $10 million or $100,000. I mean, $1 million is an easy round number for us to use for this example. With 2% inflation and a 5% withdrawal rate, this means that in the first year, you withdraw $50,000, and then every year that grows with inflation for a 30-year period. If you invest in 100% stocks, the median ending value would be $1.1 million. So if you had a middle outcome, you would have $1.1 million, and you would have been able to keep up with this 5% withdrawal rate for 30 years, growing with inflation. You would have a 69% chance of that money lasting you 30 years. If you invested in 60-40, you have around $500,000 and a 66% chance of that money lasting 30 years. If you invested in something that guaranteed you 4%, you would run out of money in 25 years. If you kept the money in your OA earning 2.5%, you would have run out of money in 21 years. And if you kept the money under your mattress, you would have run out of money in 17 years. Okay. Now let's decrease the withdrawal rate. Same situation. If you invested in 100% stocks, that means you're taking on that volatility, those swings of 40% plus up or down in any given year. You would have ended up with over 2.2 million in your bank after a 4% withdrawal rate for that period. If you invested in 60-40, 1.5 million in your bank, so $40,000 to withdraw in the first year, growing with inflation by 2%. A 93% chance, so a pretty comfortable chance in that money lasting 30 years. If I left my money in the OA and earned 2.5%, you will run out of money in 27 years. There's nothing you can do about that because you're just withdrawing from the money 4% every year. If you did not invest, you'll run out of the money in 20 years. 3%. Okay, this is the last one, so please bear with me. 3%, 100% stocks, $3.4 million after 30 years. 60% stocks, 40% bonds, $2.4 million after 30 years. So we consider a 3% withdrawal rate to be very, very, very conservative. Put another way, a 4% withdrawal rate, this is what the median outcomes would look like over time. Run out of money in 20 years if you don't invest. Run out of money in 27 years if you earn 2.5%. Have $1.45 million if you invested in 60-40, and $2.2 million if you invested in 100% stocks for the median outcome. But this is what it actually looks like. You will end up on one of these journeys. The dark blue is 100% stocks. The green is 60-40. You could be this guy, this super lucky guy that goes off the charts in the first 100 months. You could be this super unlucky guy who does worse than doing nothing. You need to understand the volatility. It is likely that you will end up somewhere in the middle here, in this middle band. But you need to behaviorally understand how you are investing, your probability of outcomes, why you may need to change your lifestyle if things are not going well, and we are here to help you through that journey. So at the end of the day, ask yourself, what will you do with your chicken? And in this three-step process, once you decide on your rate of decumulation, so that can be 3 to 5%, you can calculate how much you need to start with when you begin decumulation. In the case of this example, this person wants to spend $6,000 a month, so $72,000 a year, divides that by 4% withdrawal rate. So again, that 4% withdrawal rate, earning 60-40. So you have a 93% chance of that money lasting 30 years. 4% withdrawal rate. You simply take 72,000, scale that with inflation to when you actually start needing this cash flow, and divide that by the 4%. you'll get to a very good benchmark of a starting value. In this case, $1.8 million to keep up with this lifestyle. You can play around with these numbers and get to different outcomes. It's a very simple formula, I think, and it helps people frame what their goals should be. And Endowus will actually be developing us more tools to help you along this retirement journey very, very soon. So stay tuned for that. So using your money and making it last is about, the chicken and the eggs, your wealth chicken, your work chicken, how you work those things, determining a withdrawal rate, a level of risk that you are comfortable with, and finally enjoying life. We're just coming in on 1 hour right now. Final thoughts. Money is meant to enable your life, not control your life. That's very, very important. I think if you're coming to Endowus because you want a hot stock tip, you've come to the wrong place. We are here to help you help your money enable your life. Again, what we do is advise, build, execute, and maintain your portfolios on the platform, sitting on top of biggest and best fund managers in the world that have been implementing their strategies for a very long time. We really care about your safety. We are the first digital advisor for CPF, SRS, and Cash, so you can invest all your sources of funds through the Endowus platform. UOB Kay Hian, the largest broker in Singapore, is your custodian, but you control everything from the Endowus platform. So many of you are clients and know this already. And what you get with Endowus is access to best-in-class institutional share class funds at a lower cost with expert advice for your personalized strategic asset allocation. So multiple goals working towards multiple portfolios working towards different goals, all at a lower cost. Singapore dollar and Singapore dollar hedge solutions. So PIMCO has launched funds for us in Singapore. PIMCO is the biggest fixed income manager in the world. They have launched Singapore dollar hedged funds for us in Singapore. No lockups. So if you want to redeem, you can redeem in a single day. Daily liquidity. No sales charges, no transaction fees. We rebate all of the trailer fees. We really created Endowus. We're a bit idealistic about it because this is exactly how I want my money run, how I want the money of my family run. Very efficiently, always allocated, always working towards my goals so that I can focus on, living the life that I want with more confidence. In your world of Endowus, your goals are precisely defined. You have a process for achieving those goals, and you have access to the experts' strategies, many of which we spoke about today, and products, many of which we have exclusive access to achieve those goals. So thank you very much, everyone, for listening. You timed it to exactly 1 hour. Let me just go over to the Slido questions. So thank you guys for asking the questions. I will start with the most popular and work my way down. Thank you, Sharon. How confident is Endowus in beating the CPF OA rate of 2.5% and the SA rate of 4%? And I think, you asked that question very early on in the presentation. I saw it there. I wanted to address it systematically by going through the section of the presentation, pointing to this periodic success rate over the CPF OA, which is exactly answering your question. And the answer is, it depends on how long you are invested. So if you told me that you're only investing for 1 year, then I would say safely that if you invested in 100% stocks, you have a 65% chance of beating the 2.5%. But would I invest in my CPF OA in 100% stocks for 1 year? The answer is absolutely not. So I hope that answers your question. The longer we draw this out, so you saw for those 20-year periods, we were able to achieve, even in the worst case, beat the CPF OA rate. So CPF is your longest term money, and I think that you should be invested towards your goals at a level of risk that you can actually tolerate. So that's the way I would think about it. Okay, Sharon, another question. What would you set as a reasonable target of returns for your portfolios as we move into 2021 and the longer term? You know, in our business, another great question. In our business, we call this concept where you have inflation long-term, short-term, very safe government bonds. This can be replaced with a Singapore savings bond. Longer-term government bonds, this can be replaced with maybe a 10-year or 20-year Singapore savings bond or Singapore government bond versus stocks versus even more risky stocks. This relationship exists and is immutable in the long term. You get higher expected returns for taking on more risk. What I would say is that the relationship is relative. In 2021, I have no idea what the stock market will do. I have no idea. And anyone who says they know what the stock market will do is, in my view, selling you snake oil. Because every year, all the banks come out with their estimates on where the stock market will end up. First of all, those estimates usually have a 50% dispersion. And then no one ends up getting close consistently to where the stock market actually ends up. Also, no one holds them accountable for being wrong. But at the time that they are randomly right, maybe once every 10 years, they go around town saying, you know, I was right about the stock market, I'll be right about it again. It's simply not true. It's simply not possible, because the stock market is the biggest big data machine we have, pumping in all this information constantly through the market prices. And for us, it's about owning price. I don't have an expected return for 2021, but I do for the longer term, which is that the equity risk premium, which is equity over inflation, should be around 5 to 6%. And the credit risk premium, which means that buying global bonds versus sitting in something sitting in something more risk-free, will be around 3%. So you'll end up with a blend of that. And that all moves relatively in the long term. I mean, in the short term, anything can happen, but in the longer term, it all moves very relatively. So that's why we call the asset allocations we give you strategic passive asset allocations. Okay, I hope that answers your question. If you want as well, like, you can look at the longer term returns of these portfolios. You know, let's go to CPF, for example, because the questions were on CPF. Annualized return, calendar year return, looking back at history. As you can see, the annualized return is 8.14%. But if you go from 2003 up until 2019 and up until year to date, actually very few numbers fall even close to 8.14%. So you have to take on like bigger and bigger fluctuations as you get more and more aggressive. Now, if we get more conservative, the dispersion of outcomes decreases, right? So this is a 3.3% annualized return. And as you can see here, a lot of more of the numbers fall much closer to that 3.3%. So I hope this is a very useful illustration of volatility and being closer to that expected return. Okay, let's continue. Using CPF monies to invest Endowus Line Global Infinity US 500 Stock Index Fund, is this considered an aggressive investment? I consider it an aggressive investment. I guess, okay, so in the spectrum of possible investments, it is aggressive for two reasons. Number one, it's 100% stocks. So what we saw previously is that stocks have a higher expected return, but they take on more volatility. Number two, although it is very diversified, it's diversified into the 500 largest companies in the US. it is also only in the US. So, even though in recent times, investing in such a portfolio would have outperformed investing in a globally diversified portfolio of stocks, there are periods where the S&P 500 can return next to nothing. In the case of 2000 and 2009, the S&P 500 index actually had a negative total return of almost 10%, including reinvested dividends. So you want to avoid this lost decade syndrome, which is why our advised portfolios actually are much more globally diversified than just the S&P 500. Do I think it's an appropriate investment for your CPF? Depending on how long you have until you start withdrawing from your CPF, I think actually the S&P 500 is a good investment. I would obviously prefer a more globally diversified portfolio, such as the advised portfolios in Endowus, but the S&P 500 is a very diversified, very low cost option that has high expected returns. Question from Anonymous. When selling, what will the price of my funds be? Same day, next day, funds fixing price. So I think the question is around, like, when I put in a buy order or sell order on Endowus, what price am I getting? We deal in unit trusts, which are priced once a day at so-called their net asset value. So when you put in a sell order before a certain cutoff time, you will get that day's NAV pricing. But it's that day's NAV pricing is not out until after you've already put in that sell order. So we don't know exactly what the price will be. This is how mutual funds or unit trusts are traded globally. Okay, so so if you're after the cutoff time, it will be the next business day's pricing. Okay, great. Next question from Anonymous. Could you share a bit about the financial advisory service that Endowus provides? Aren't there only a fixed number of portfolios available for investors? There are a fixed, okay, so this will be better served by an example. When you log into the Endowus account, you can see you can see, and you can create multiple goals on the platform. You can see how, when you create a goal, you can decide how you want to invest it. So you can invest in Cash Smart, general wealth accumulation, or you can actually customize your own portfolio on the platform with FundSmart. A lot of what we talked about today was around our more advised portfolios, but actually you can customize and construct whatever you want based on the funds that we have approved to be on our platform, based on their track record, implementation, cost, strategies, etc. For all of your money. So for example, I can invest for general wealth accumulation with my cash, determine my loss tolerance being low, medium, high. In this case, I'm investing for the long term. Okay, let's use this example of CPF OA for Lion Global Infinity. I can invest in the Lion Global Infinity US stock fund and invest with 100% of my money, or I can add a fund and invest with, and complement that with, for example, the Lion Global Stock Index Fund and invest 50-50. I enter initial investment and I can press continue. I'll immediately get to see that the portfolio is in line with my stated risk tolerance. It has had an average annual return of 7% since 2003. Total fees of just 0.83%. There's more on fees below. Best and worst outcomes. So what to expect in a single 12-month period of returns. what is actually in the portfolio based on size of companies. So this is what is in the portfolio consolidated for you. And what are the actual fees? So as we mentioned earlier, Endowus rebates what the industry calls the trailer fee, 100% to the end client. The Endowus access fee in this case is 40 basis points. Endowus has exclusive access to these funds. Your total annual fee is 83 basis points. You can see the historical returns of this portfolio as well. So through FundSmart, I think I'm going back to answer your question, you're able to get advice and build customized portfolios. Now, if a customized portfolio is not what I'm looking for, I can choose CashSmart, invest my cash savings, expected returns of 0.9 to 1% or 1.5 to 1.7% for a very safe, low volatility portfolio. Or general wealth accumulation, which is what we talked about a lot today, and say I want to invest my CPF OA. I'm 33 years old, my annual income is XYZ, and I have an initial investment of, let's say, $50,000. And for this investment, I want to preserve my capital, grow my capital, and maximize my returns. As I'm investing my CPF for the long term, I can say I want to maximize my returns, and the most volatility I can tolerate is 42%. Continue from there. I'll call this retirement, CPF, retirement, yeah. Continue. And it will see that it produced an 80% stocks, 20% bond portfolio for me. I can set on a recurring investment, so on and so forth. And what you end up with as you construct and move your money to the Endowus platform, what you actually end up with is multiple goals. So in the case of this client, she has goals, general wealth accumulation, which is invested with her SRS, CPF, and cash, CPF 60/40 goal, an Endowus core, Endowus CashSmart enhanced, 100% bond goal, which might be for a very near-term need, and a FundSmart goal. So this is a customized portfolio for whatever, which is 50% stocks, 50% bonds, for example. So the Endowus platform is built as an advisory platform. There are not just a fixed number of portfolios. You can have multiple portfolios working towards multiple different goals, and you can even construct your own portfolios to run at a low cost on the Endowus platform. Okay, question from Nick. What are your thoughts on the equity market as China overtakes the US in the future? You know, I think the longer term, I think we have time for just a few more questions. So I'll answer up until the ones that were upvoted here. But you know, the China has been growing its GDP very quickly for the last 25 years, but that has not necessarily translated into equity market returns. I think there will be more and more equity moving over to China, but our philosophy is to be close to market cap weighted in geography. Market cap weighted means depending on the size of each country's market cap, we weight the portfolio accordingly. So as this transition happens, if and when it happens, we don't know when it will happen, the portfolio will adjust itself to take care of China making up more and more of the global equity markets. Next question. How does Endowus portfolio take into account the long-term view for China to rise and US relatively decline? Answer to the same question. I'll just raise one more point here about this lost decade. 2000 to 2009, you know, everyone thought that emerging markets were the future. Brazil, Russia, India, China, all new economies that have opened up. 2010 to 2019, that decade, they had the worst returns in the world. 2010 to 2019, China was still growing faster than these other sectors, developed markets, Japan and the US, but the equity markets were the worst. So it's very, very difficult to it's very difficult to time when this transition will happen. And if you're too early, you can end up with you can end up with multiple lost decades. If you're too late, you will miss out on the upside. So we try not to guess which markets will outperform and when because that just lowers your probability of success and increases your dispersion of outcomes. So we do not think it is sound advice. Do core portfolios offered have the possibility of going through any re-optimizations in the future? So for those of you who have been clients of Endowus for, I guess, over a year, you would have gone through a couple recommended portfolio changes in the past. And what a recommended portfolio change is that we find different components of the portfolio to make the portfolio more efficient. We continue to look for those components in order to make our portfolios more efficient. So, and being efficient, we won't be re-optimizing based on our views of market changes. We're re-optimizing based on geographies as those geographies change in their size. And we don't know when that will happen. And based on our ability to access products at a lower cost with better implementation to achieve higher expected returns for every unit of risk taken. And that is our job as your financial advisor. Okay. I think, okay, let me just, there's a lot of questions here. I'll answer three more. I'm conscious of the time. We're coming in on an hour and a half. How should we decide between investing through SRS or straight into SA? Is liquidity the only factor? I think this question, investing through SRS or straight into SA. I assume SA, you're referring to the special account. So what I would say about this is SRS is your long-term money and it earns 0.05% in the bank. So if you're thinking about investing, I would definitely be investing that SRS bucket. The special account earns 4% on the portion that is investable. The SA is illiquid because you cannot take it out until you're past a certain age, and after withdrawal age, you need to take your SA out first before you can take out your OA. It's hard to beat 4% guaranteed, but if you have a long enough time period, then it still makes sense to invest that money as long as it's invested properly. Endowus is working on a solution for special account investment as well. So stay tuned for that. But in terms of the order of investment, I would invest SRS first to answer that question. Okay. Are there any plans to include ARC fund into Endowus portfolio? Again, the ARC funds, and Kathy Wood has done a fantastic job in expressing her investment philosophy. The ARC funds are extremely thematic, and they will go through hot booms and busts, and have a very, very large dispersion of outcomes. To me, the ARC fund is a perfect satellite position, not a core position of any portfolio. We're looking at thematic funds to add to the Fund Smart solution to make them available on the Endowus platform. ARC is one that we are considering. Okay. How would you consider Endowus as active management? Do you all look at changes in the market and reallocate the portfolio? The answer is absolutely not. Endowus is a passive, strategic asset allocator. This is very different from a lot of other offerings out there, which are active and actively changing your portfolio based on the way they see the market. It is too hard to look at the market and try and reallocate your portfolio. As you will have seen in a lot of other platforms, they have made some good calls, they have made some bad calls, but longer term, the market will win out. And we believe that a strategic passive asset allocation towards your goals is the right way to invest. So thank you. Thank you for that question. The only thing we do is actually rebalance your portfolio if and when it strays too far away from your target asset allocation. So if you're invested in 60-40 and it swings to 64-36, we will sell down that extra 4% and buy the extra 4% that's missing from the bonds to bring your portfolio back in line with your goal. And that is the extent of our rebalancing. Okay. I think that answers the bulk of the questions. And guys, we're coming in on an hour and a half. I'm conscious of the time. We'll be sending a follow-up email, and feel free to ask your questions there to all the attendees. If you are not an Endowus client, please, we would love for you to try out the platform. For existing Endowus clients, thank you again for joining us tonight. I hope tonight was a good refresher course on why you've chosen Endowus as your financial advisor. So thank you, everyone. I'll conclude the presentation tonight on that note, and wish everyone a good night. So thank you.